My name is Andy Crook and I'm your host for tonight's training topic on the balance sheet. The balance sheet follows a fundamental equation. Assets equals liabilities plus shareholders' equity. This equation must always balance, hence the name, the balance sheet. It is a crucial document for investors, creditors and analysts as it provides insights into a company's financial health, liquidity and overall stability. Understanding how to read a balance sheet is essential for an independent garage owner to look at how his business is performing in terms of its overall sort of stability is probably the best word. How stable the business is. Are we building a business on solid foundations? That's one of the things the balance sheet can do. So let's get on with the first section, which is what is a balance sheet? So the balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It's typically looked at the end of a quarter or the fiscal year, the financial year. It presents the company's assets, liabilities and the shareholders' equity in a document. What it doesn't do is it doesn't depict everything that a business owner needs to look at. So it's part of a sequence of training topics that I've been putting together called Know Your Business, Know Your Numbers. So the balance sheet can't be looked at in isolation. It has to be looked at alongside some of the other documents we'll be looking at in this series, such as the profit and loss statement. The balance sheet goes alongside that because this doesn't tell you whether or not a business is profitable or not. But it does indicate how the business is using its resources efficiently or if it's taken on too much debt. It's one of the sort of documents that you have to produce. It's legally required. It's a balance sheet, and your accountant often does this for you. And what it provides anyone looking at the balance sheet is by looking at the current and fixed assets of a company, the balance sheet can demonstrate the financial resilience of a business. So it's often looked at, the balance sheet, you're often asked to provide the books and alongside the sort of other financial statements. When you go for example, a loan, one of the things the bank or the creditor will do is they will look at your balance sheet because it contains information, and that's why it's really important to learn how to read the balance sheet so we can look at it through the same lens, if you like, as other people do when they analyse the business for various reasons. So to do that, we need to look at the three major components of a balance sheet, which we've already said, is its assets, liabilities and equity. They're the three components, if you like, of the balance sheet. So the first thing we can look at is the assets. And these represent what the company owns or has control over. They can include cash, inventory, property, equipment, investments, accounts receivable, which is a financial term for money owned to the company, and other tangible or intangible items of value. So when we talk about intangible items of value, it could be the value of your website or other things like that, things that don't, you can't physically touch them, but they have a value. And we've talked about this in a previous training topic. So they're your assets, basically what the company owns or has control over. And the next thing we need to look at in terms of the balance sheet, we know what our assets are now we need to look at our liabilities. And the liabilities are simply the company's obligations or debts. And they will include loans, accounts payable, and once again this is just a financial term for money the company owes to others, so invoices that you owe to other businesses normally, accrued expenses and other financial obligations. So your liabilities is basically what you owe other people. And the assets and the liabilities form the two major parts of the balance sheet, and the final part is the equity. And this element of the balance sheet shows the portion of the company that belongs to its shareholders. It's calculated as the difference between the total assets and total liabilities. Shareholders' equity includes common stock, additional paid-in capital, retained earnings, and other components depending on the company's structure. So obviously what we're talking about when we're talking about how to read a balance sheet and what the balance sheet tells a business is the basics of looking at it, but it can get far more complicated depending on the makeup of your company's shares, for example. But also in the equity, we ought to look at retained earnings, so money that's retained by the company that has been earned by maybe the director, or money that the directors have paid in, so directors' loans and stuff like that. That all sits within the equity bit. But basically, what happens when we look at the balance sheet, it must always balance. So assets equals liabilities plus shareholders' equity, and that's how it must look. So it's not always straightforward when you look at it where all these things sit. So what we're going to cover now, very briefly, is how to read a balance sheet. And the problem with it is because the way the information is presented, it can seem complex reading a balance sheet, but once we break it down, it makes it slightly easier to wrap your head around and sort of understand how the company looks in terms of the people who read a balance sheet professionally, how they look at this and what they can glean from that information. And once we've covered that, then we can look at some typical ways of analysing the data and how it's sort of put in front of you, so you can make sort of simple calculations that you can do with a balance sheet that give you some information or ways of monitoring the success of the business, or improvements, if you like, within the business. And then we can compare over time or industry. They're the things we're going to look at now, which is why we have to cover the previous bit. What is a balance sheet, what's in it, is so that we understand how to read it. So we start off with the assets, and that is cash, property and equipment. That's the easy way of thinking about it. These are listed on the balance sheet, and the value of these is listed on the balance sheet. And the next bit that it looks at is the liabilities. So short-term and long-term debt and any deferred tax are typically in your liabilities. Now, when we're talking about short-term debt, that could be, for example, an overdraft. That tends to be a short-term debt. A long-term debt could be a bank loan. And there's a difference between those two in terms of the term. Also, you could have any tax that you've deferred, so a tax bill you haven't paid, but you need to pay within a time frame. That can be normally a bit, typically that becomes a long-term debt, but it could be that you've deferred it for a shorter period of time, depending on what you've agreed. And then the equity, basically, is once you've got the assets and you've taken away the liabilities, is the equity positive or negative? That's the simple way of looking at this. So if there are more assets than liabilities, the equity is positive, and if there are more liabilities than assets, the equity is negative. So understanding the balance sheet, though, involves looking beyond the numbers and considering the context, industry norms and company strategy. And you need to seek guidance from financial professionals or analysts for a more comprehensive assessment. But some basic stuff that we can do, and we're going to look at some typical analysis that are quick and easy to do with your balance sheet, that can make your balance sheet mean more to you. It's worth doing and worth seeing how things are improving. So we know that from previous training topics or just common knowledge that lots and lots of businesses fail because of cash flow. And sad but true, this is often the case. And a business can be profitable, but if the cash flow isn't happening in the right way, the business can begin to struggle. So one of the things we talk about when we look at fixing first things first, which is another training topic, one of the things we looked into was do we have enough cash flow? Are we having positive cash flow each month? Because that's one of the first things we need to turn around in our business if that's not happening. And then once we've got positive cash flow, we then need to look at, do we have enough, if you like, money in the bank to sustain us over 3 to 6 months of trading if no income happens. Now, this used to be doled out as advice, and many businesses just simply said, well, that's just impossible, it's not worth it, having that amount of cash in the bank isn't worth it. And before COVID came along, I bet most people felt like that. But since COVID, I bet more and more people are thinking, right, it might be better to have an amount of working capital at hand should something unexpected happen. And I mean unexpected as it goes. The government turns around one day and tells you to stop trading is as unexpected as it gets. But businesses that had positive equity, they had cash at hand, were able to sort of weather that storm, that initial storm where everyone started to panic, more comfortably than businesses that had negative equity or very little cash at hand. So one of the first things that is worth doing with a balance sheet is something called the current ratio. And basically this piece of analysis allows you to sort of look at the your business or another business's ability to cover short-term liabilities with their short-term assets. Basically, often this is really about what can you lay your hands on quickly to satisfy a short-term liability. And it's basically looking at current assets and current liabilities, which are often split out in the balance sheet. So divide your current assets by your current liabilities, and this will give you a ratio called the current ratio. And you want this to be positive. You want your current assets to be greater than your current liabilities, because this means that you are in a good position in terms of having the ability to cover your short-term liabilities should the unthinkable happen. And this is a good ratio for looking for the stability of the business. So that's the one, if you like, piece of analysis I would urge everyone to do. It's coming up to the end of the year. If the end of the year coincides with the end of your financial year, then when you see your paperwork, do that simple task. Divide your current asset by your current liabilities and have a look at what that ratio is, and then work on improving that ratio, having more assets, current assets, than current liabilities in your business, and you will always be in a stronger position. The next one to look at is the debt to equity ratio, which is, it shows how much the company relies on debt financing versus the equity. Now, if you don't have a lot of equity, or your equity is negative, and you want to continue trading, however you want to do that, you are now relying on debt to continue trading. And it's not a great position to be in, but there are two types of debt. And once again, we've done this in another training topic. There are what I call good debt and what I call bad debt. And good debt is debt that allows the company to grow, that is providing a return on its investment. So that's money that's making the company better. And bad debt is short-term borrowing, credit cards, stuff like that, to pay pizza to rob Paul, effectively. And the debt to equity ratio, basically how you work this one out, how this ratio is calculated is you divide the total liabilities by the shareholders' equity. So you take all your liabilities and you divide it by the equity. And if obviously, once again, this can be positive or negative, and it may be that some of your liabilities, so a long-term loan, could be a mortgage. So this could be still negative, but that's good debt. But it gives you an idea of how the company is financing its growth or its existence. So that's another good one to do. Probably not as important initially as doing the current ratio, which is the one I'd urge you to do as atomic action for this particular training topic. And the final one I'm going to talk about is asset composition. Analyze the types of assets and liabilities that the company has. So look at cash, inventory, and investments the business has, and it's sort of its liabilities, the short-term debt, the long-term loans, and understand the composition and liquidity of the business. So this, by looking at this, you can often get a feel for, but just by looking at the balance sheet, you look at comparing or analysing the types of assets, cash at hand, amount of stock holding or inventory, and the investments a business is making against its short-term debt and its long-term loans. Will give you an idea of how this business is, the financial makeup of this business, and how stable it is within the current market. So they're the three types of analysis you can easily do once you understand how to read the balance sheet. Once you understand the assets, the liabilities, and the equity, and the main thing to look at here in the equity side of things is it positive, is it negative? And then look at the one I would urge you to do is the current ratio, which is dividing your current assets by your current liabilities. So your short-term debt against effectively what you can lay your hands on in terms of money today. And that gives you a good idea of how well you could weather a sudden unexpected storm, such as COVID-19, which is if you go by storms, that is the yardstick of all yardsticks. So then, what about comparing over time in industry? So if we started to monitor, or if you went back through all your balance sheets, which you will have if you've been trading any period of time, and you've been providing financial statements at the end of every year, you could compare the current balance sheet with the previous periods to identify trends in your company's financial health. So you could do the current ratio each year for the previous years you've been trading and seeing if it's improving or is it getting worse. You could have looked at the debt to equity ratio, and are you relying more on borrowing now than you were, say, 3 or 4 years ago? What has changed in the business to make that happen, and what could you do to improve that situation? Or is the borrowing good borrowing? Is it making the company grow? They're the trend analysis of comparing over a period of time. If you haven't got a load of financial statements that you can rely on, you can start today and then compare going forward. You can compare quarterly as opposed to yearly to begin with, to build a picture of how the business is getting on. And then finally, industry benchmarks. Compare the company's ratios and figures with industry averages to gauge its performance against your competitors. Now, these figures don't sort of just appear out of nowhere. So it's very difficult to compare, if you like, industry benchmarks. But if you were to look at your closest competitors, if they're public companies, they will all have to submit their balance sheet to Companies House every year. So you can have a look at, say, 10 companies in your locality, average up some of those analysis. You could have a look at the equity of the companies, average it. You could look at the current ratio of all 10 companies and average it, and get an idea of the industry benchmark in your area or in your competitive niche, and see how you fare against them. It's another way of using the balance sheet. Hopefully this has been informative, it's helped you understand what the balance sheet is. If nothing else, you may now be able to have a better conversation with your financial advisors and your accountant about the balance sheet, and maybe look at the balance sheet in a slightly different way and do some simple analysis on it. Once again, the atomic action for tonight's training is have a look at your current ratio, because that's the one that allows you or gives you an indication of how well you'll be able to weather any short-term financial storms. If I've made you think about how you operate your business, then I've done my job. If you've got any questions, send me a message. I'll get in touch with you. Remember, always seek professional financial advice. Thanks for listening.